I'm here today with emerging fund manager Jeff Tiefenthaler, whose fund focuses on crypto predominantly, right? Is that fair to say, Jeff?
I would say Bitcoin, digital assets.
Jeff and I met through the same program, Black Card, which helps emerging fund managers launch their fund and helps them with a whole bunch of stuff, right? The legal aspect, the marketing aspect, and so on and so forth. But it's a pleasure just to meet people like Jeff through the program. I think that was kind of the biggest value for me personally. So really happy to have met you, Jeff. Welcome to the podcast.
Thanks, David. It's great to be here.
So I just want to start off, maybe like you could just tell us about yourself a little bit, like how you got into, trading and crypto and how you found yourself, launching a fund.
For sure. It's good to be here with you. My trading journey started when I was a teenager, actually. By the time I was 18, my dad had taken me to the local Scottrade brokerage office there in Tacoma, Washington, and he just told me, he's like, I think you might enjoy this. I think you could be really good at this. And I remember I had like $2,000 that I had saved up over the summer, and it was just sitting there in my bank account, right? And so my dad and I were talking. He's like, let's set up a brokerage account for you. So I did that, and I remember the first two equities that I purchased were Apple stock and Schlumberger, which
Yeah.
is an oil producer. And I remember like just within a few months, both of those went up and I had a profit, and I was like, oh, sweet, I'm taking this. So I sold it and I took the money and I started trading other things. Had I had held it, I would have been much better off. But my journey really started off trading and, trying to find fluctuations in the market, doing technical analysis, really just being an active participant in the market was what I was drawn and attracted to. That was sort of my start. But
Sorry, what year was that? But basically, when you first bought that Apple.
2003.
It's funny because I had a similar experience. I don't know the precise year, but it was definitely when Apple was in the dumps, and I had also saved up some money. And the internet was just kind of getting usable, and I don't remember exactly how, but I guess there were online brokerages. There must have been. But yeah, I also bought some Apple stock and sold it. Like it went up 30%, and I was like, yes, I'm keeping this. Yeah, continue. You were saying after that.
Oh yeah, and then I continued to just enjoy understanding and learning about the markets. I really dove into some books like Market Wizards, The Indomitable Investor, any kind of educational content I could get my head around, like Robert Kiyosaki's Rich Dad Poor Dad. He had a seminar on learning how to trade, and I really just had a passion for it and wanted to be a trader. I told myself I wanted to be a trader. Of course, it wasn't really viable at that time because I still needed to generate income. I had a job. I graduated from college in 2008. You know, thought I wanted to be a lawyer. Took the LSAT. Decided this world doesn't need another lawyer. Ended up teaching English abroad in Greece and then Mexico. And then while I was in Mexico, got a job working for Holland America Cruise Line, which is an amazing opportunity. I traveled all around the world. I've been to more countries than I have cities in the United States. And I still sort of kept up with the market during all that. But it wasn't a big part of my life until like 2012, 2013, when I had some investable income and I started really trading more actively and full time. And then in 2014, joined a partnership. Me and my two partners, we developed some software for trading around a particular day trading strategy, which worked really well at that time. And we just continued to develop our algorithms and our software and licensed our software to other friends and families and high net worth individuals. And that was my foray into algorithmic trading and working with APIs from like TD Ameritrade and Interactive Brokers, E-Trade, and then other market data providers like Polygon.io, and some other APIs.
Just curious, how did you get into that particular style of algorithmic trading and avoid getting lost in the technical analysis kind of, I don't know what you think about technical analysis, but to me, a lot of it sounds like mumbo jumbo and people can spend a lot of time there. I guess some people
Yeah.
get really good at it, but I would guess like most people probably it doesn't really work. Like whereas like trading around news, if you like the system that you showed me, it makes sense why it would actually give you some kind of edge. How did you kind of sidestep that
Yeah.
and get into something that actually worked?
Yeah. So in 2014, a friend and a person that I know well asked me to come trade and invest with them. And of course, in return for that, they wanted 30% of my profit pre-tax. But because I knew of this person's reputation, I decided that it was a fair trade-off. And I started trading with them, and this was a day trade strategy, sort of like a scalping trading strategy. I wouldn't say a high frequency trading strategy, but definitely in and out within 15 minutes or so.
Mhm.
And it worked pretty well, but there were some clear disadvantages because at that point, the system was completely manual. And so I approached him and I told him, I said, look, I think we can automate this and that will give us a better advantage and we'll do really well. And with his blessing, he said, yes, let's do it. My neighbor at that time, he's a really good software developer, focuses on the .NET framework and C Sharp. And so I talked to him about building out this system and automating it. And he joined us. And so the three of us, we formed a software company and several partnerships and started developing the algorithms and pretty much licensing them to ourselves at
Mhm.
that point. And you're right, it wasn't a strategy based on technical analysis. In fact, it was a very simple strategy, right? There are really three key ingredients to this strategy. And if you got those three key ingredients right, you had a pretty high chance of success. Like our win rate for some time was between 85 and 90%.
Mhm.
And we were doing, some years 500% return on capital, up to like $2.5 million. The problem is the more money you have under management, the harder it is to generate those kind of returns. But we did have quite a bit of success early on trading that strategy, not using technical analysis. There are a few different indicators that I like when it comes to TA, but for the most part, I like a nice clean chart.
What asset class was that? That was equities also, or?
Yep, that was public equities and options. I would say about two-thirds of those trades were options, and the other third was public equities.
It's really hard. Well, I guess that's one of the pros and cons to being kind of an emerging manager. By emerging, I mean like anyone managing less than $100 million. So like, it's like when you get into the fund space, you realize that, a micro fund goes up to like 20 million AUM, right? And then I guess like the middle of the range kind of start, or sort of the small end of the range starts, and then the middle, and then large is like billions. But yeah, that's one of the advantages of being small, right? You can generate these superior returns, but then you do as you scale, like you have to maybe compromise on the returns to
Right.
accept more capital. Yeah, yeah. Because otherwise you just be generating unimaginable wealth
Yeah.
that would make no sense. Yeah.
And it was really interesting too, because my entry into being a full-time professional day trader was really my entry to being a full-time DGen, because the irony of our strategy is that we were buying out of the money call options that sometimes would expire within a couple weeks or less. And that is not an advisable strategy at all for
Mhm.
most people. That's actually a sure way to lose money.
Yeah.
But we had a system that allowed us to really get into these low risk setups for about 15 minutes. But for the most part, I would I would share that strategy with people, and they would look at me in bewilderment because they just thought it was completely insane and crazy what I was doing. Yet So I kind of like to say like I was an original DGen before the whole
Yeah.
crypto phase.
Well, I don't know the details of your strategy, but it could make sense. Let's say, I mean, if you're only in 15 minutes, right? 15 minutes compared to a few weeks is still pretty big difference in time scale. So you're not that affected by the theta, right? The
Right.
time decay. I guess like I could imagine like if you have some insight into volatility spiking, like for a bit, then you can make a profit.
That's exactly right. Yeah, because
Yeah.
we would anticipate the implied volatility at least creating a floor underneath those options, right? So at
Mm,
times we would get into a trade and the underlying equity wouldn't go anywhere, or perhaps it would even go down. But those
yeah.
options premium would keep those contracts elevated and even increase the price of the contract so that we would end up doing all right. I've seen some really bizarre things trading as long as I have with options and implied volatility. I remember one of the craziest trades I was in was the equity was just, we were long calls. We bought to open options. They were short dated options. I'm sure they were expiring within a few months or less. And
Mhm.
the stock was just tanking.
Yeah.
And I remember I had an order out there to sell those options at about 50% higher than the price that I paid. And they took them. I got filled and I made a decent chunk of change on that trade despite the stock going down.
Yeah.
And when you have an option illiquid options market, whoever is selling me those options, if they didn't know like why I was buying them and they just thought I was being a degen without a system, then that was probably their assumption, right? But they got caught on the wrong side of that trade,
Mm,
which was interesting. And I've been caught on the wrong side of the trade many times too, but
yeah.
that whole experience was something else.
Yeah, yeah. So yeah, essentially you had a better model for like the implied volatility than they did, and like, that kind of dominated the fluctuation in price because they were deep out of the money anyways. Makes sense. I do wonder where the professional or like not to say we aren't professionals, but I mean like the big boy market makers were like Citadel and others who make those options markets. Probably I guess maybe you're focusing on kind of like some kind of more less liquid stocks or something that
Yeah.
where you could really have an advantage.
And it's also a matter of being early, right? It's a matter of being early and quick. And that's part of the reason why we automated this strategy was because it was taking too much time to actually extract the relevant information
Mm,
and make a decision. And automating that whole process saved us 30 seconds, 30 seconds to a minute, and we're operating in really milliseconds there, right? If we can be
mm,
milliseconds faster, we're doing well. This particular strategy, though, I believe has suffered from some natural entropy. There's no system that lasts forever.
mm,
Markets are, fluctuating and always in
yeah.
this evolving state. And so this particular strategy, I think, has come under scrutiny because for several reasons. One, the Wall Street bets guys and the GameStop and the AMC
Yeah.
traders disrupted, the payment for order flow model that these exchanges have. And so,
Mhm.
whenever a retail trader buys something from their Schwab account or their Fidelity account, and it's a margin account, those trades are being routed to a desk like a Citadel or a Wolverine or some exchange, right? And the
Yeah.
reason why the commissions are so cheap these days, the reason why you don't have to pay hardly anything to trade is because retail traders' orders are being routed to unfavorable locations where they're just going to be
Yeah. And then guys like algo traders like you and me never even get a chance at that flow, right? It's taken
right.
by these guys. Yeah. Yeah. When was this? What year more or less was the strategy working? Just
Our best years were 2019.
Mm.
2020 was a phenomenal year. 2021 was also a really good year. Yeah, those were the
That's
best
actually
years.
surprisingly recent. Because I mean, when I was working at Citadel, I'm constrained by my lifetime non-compete. But I mean, from my general knowledge of the industry at that time, I mean, order flow was already being rerouted to retail order flow was already being rerouted to these firms. But yeah, no, it just goes to show you can find inefficiencies still, even with these big players around.
For sure. Yeah, and we had I would say really from 2014 to 2021, we were doing really well. We were just able to scale it in 2019, 2020, and 2021. We were able to scale it and really push our boundaries to see how much, capital we could actually throw at this particular strategy.
Mm,
And in some ways, I think we may have broken the strategy by doing that,
mm,
because we drew attention that we didn't really expect. I remember having several conversations with the compliance team at Interact Brokers, and they were just asking me like, "Why are you trading this?" And I'm like, "Well, what do I have to tell you why?" And they're like,
yeah.
"Yeah, you do. If you don't tell us why, we're going to shut down your account." So I was like, "Oh, okay." So that was an
Mm.
interesting experience with that particular broker.
Yeah, it's tricky. Unfortunately, when you get into the nitty gritty of algorithmic trading and you start to question, like, you're not like naive about it. Like maybe you're optimistic about it. Like, yeah, regulator markets, even playing field, all this stuff. But then you start to ask yourself questions like, wow, like the brokerage has access to like the data of what each and every single player is doing. That's extremely valuable, extremely monetizable. Even just like small differences in access to public data feeds like APIs, like if they give someone else like a 10 millisecond latency advantage or 50 millisecond, that's huge, right? And so you start to wonder like, well, I don't see anything in the terms and conditions that prohibits any of this behavior. And no one's really talking about it. And you start to feel like you're on shaky ground. Like I actually don't know where I stand with respect to these variables, and if someone has a massive edge over me. So that seems really challenging, right? Like, have you thought about that?
Oh, absolutely, 100%. You hit the head on the nail with that. There is no quote unquote privacy when it comes to trading in public markets, right? Um, and I don't mean to use the word privacy in the sense that, we're trying to hide anything, right? We're not doing anything illegal or unethical. Privacy to me is just the absence of information leakage
Hmm.
or giving consent. If you think about it, when you're trading, you're creating a profile around the kind of trader you are. Just like when you create a profile on Facebook, and Facebook's algorithms know what your tastes are and what your interests are, and so they deliver advertising to you. They know all about you. They know more than you think they do.
Yeah.
Same with your broker, right? They know what IP addresses you're trading from. They know when you're clicking around on their platform. They know when
Yeah.
what you're looking at. They know so much about you. And it's not just like what your portfolio construction is, but it's really interesting how much information I bet that they have around the traders. And so I think that does play a factor in algorithmic trading and developing algorithms. And it's like, in a way, you want to compartmentalize everything that you're doing. You kind of want to decentralize your operations, right? So you might get quotes from one place, and you might submit orders to another place,
Yeah.
and it just, I think, makes sense to think about it in terms of like you're playing 3D chess when you're creating an algorithmic trading system, knowing that there is going to be information leakage, and so you want to be able to contain that as much as you can.
Yeah. No, it's crazy. Because I'm sure like in regulated markets, a lot of the worst stuff should be like in theory illegal, but then like there are so many gray zones and you know, there's a lot of information leakage, as you say. How do you know someone in the compliance department doesn't like just chat with someone in the trading department or some friend about this guy who's doing 500% returns, and they had to investigate him because it looked sketchy, but then it turned into it was just like a legit trading strategy. And you don't really need too many details to figure out, oh, like maybe to kind of like reconstruct a strategy. I think like there's a lot in execution, but there's a lot also just in knowing where to look and knowing that someone else is doing it profitably.
It reminds me of that book, bringing down the house.
Don't know the book.
You've probably seen the movie. It's the 21 movie, the blackjack movie, where the professor from MIT, Jeff, I think his name is Jeff Ma. He
Mhm.
teaches his students at MIT how to count cards in
Mm.
blackjack, and then
Mm.
they go to Vegas and they're in the casinos, they're playing blackjack, they're winning and winning, and the casino's like, how is this possible? They must be cheating. They must be doing something illegal. So they take them to the back and they interrogate them, and they don't find anything because they're just counting cards. And sure enough, they end up getting kicked out of the casino, right? And so I
Mm.
think that's what happens when you're a successful algorithmic trader, right? They kind
Mm.
of take you to the back and they interrogate you a little bit and try to figure out what's going on. And if like you just keep winning, then there's a good chance that they may either do something to thwart that, like you're saying, like create some sort of latency, or they'll just straight up kick you out of the brokerage.
Yeah, yeah. I guess what also that's really annoying. It's like KYC and AML. Like I understand it has some purpose, but oftentimes I think it really like cuts you from underneath the knees sometimes, right? Like you're in this process for months, you've done nothing wrong, and they just want like more and more information, and there are lots of ways they can kind of limit you. I don't know if it's intentional or not, but I think what bugs me most is just like the informational disadvantage that potentially exists. Like you don't know what they're using, uh, how they're using your information, and you don't know if someone else is like paying and getting some special privilege. So then
Mm.
you're, at a disadvantage with respect to kind of the bigger guys. Okay, yeah. Well, yeah. Let's move on to like. So, what are you doing today with you're bootstrapping this fund? Can you tell us a little bit about that? Tell me.
So the Bitcoin Denominator Group is going to be the name of the fund, and I'm just getting into the whole legal phase right now, working with attorneys, getting the entities set up. The goal of the fund is to acquire as much Bitcoin as possible and not lose it.
Okay.
And unfortunately, those are two real difficult things for a lot of people. I think the problems that I'm trying to solve is one, I'm a Bitcoiner first. I'm not opposed to digital assets. In fact, I own a handful of other select cryptocurrencies. Um, but I think oftentimes people get carried away by other cryptocurrencies and they lose their focus on who the king at the table is, and that's Bitcoin, right? So we want to maintain a focus on Bitcoin. And so we help investors do that. But we also want to make sure that they don't lose their Bitcoin, which is another problem. I've heard so many horror stories from people who somehow, some way or another lost their Bitcoin. There's a million different ways to do that. So we want to be able to provide, good multi-custodial or multi-signature custodial solutions for our investors, which would also include proof of reserves so that they can see that we actually have the Bitcoin that we say we have. And then on top of that, we are going to repurpose some of our software so that we can take advantage of the digital asset market, which is around the clock 24/7. I can't be behind my screens all day, every day, and certain things happen in the market, and we'll be positioned to take advantage of that volatility when it happens. So yeah, right now I can't speak too specifically with regard to the terms of that since we haven't gone through the legal yet. And I don't want to, come across as marketing or soliciting this fund. It will be a 506B fund, Reg D 506B fund, and we're looking to raise about $5 million to $25 million this year.
To be clear, like nothing here is solicitation. The fund isn't even set up, so it would actually be theoretically impossible to do so at this point, even. But and nothing is financial advice here either, of course. So you mentioned you have some ideas in mind or some strategy in mind to take advantage of the volatility. Like, can you give a little bit more detail of how that might work?
Yeah, I think the public markets are going to provide that opportunity, right? Because the question that a lot of investors have is why should I invest with you? Why shouldn't I just invest in Bitcoin and be good? But Bitcoin's had approximately a 50% CAGR for the last 5 years. And so my goal is to outperform that, right? And I believe that in order to do that, I can do two things. One, we can put some of the AUM into the public markets, which will allow us to take advantage of the volatility that particular equity instruments have, like MicroStrategy or Similar Scientific or Mara. These companies are going to fluctuate a lot. And so I think there's an opportunity right now for active traders to
Mm,
really get in and pick their spots and snipe out some of these opportunities, which really supersedes the passive investment style that we've seen for the last 30 to 50 years or whatnot. I think we're moving into a time where active traders are going to really start outperforming the benchmark averages, at least good active traders,
mm,
ones who have experience and know what they're doing. But the options market is also a way to provide that alpha, but not only provide alpha, we can use the options market to hedge, right? So let's say Bitcoin's at 500K and we're getting some indicators. We're looking at pi cycle top, we're looking at MVRVZ score, we're looking at the NUPL indicator, and we're just kind of seeing that there's a little bit of froth. Well, rather than selling our core Bitcoin position, which will be in spot cold storage Bitcoin, we'll also have a position in the public market with the ETFs. And at that point, we can decide to sell the ETFs, short the ETFs, or hedge the ETFs by selling covered calls. Or you can sell a short call spread. I'm not an advocate per se of shorting. It's not a big part of my strategy, but that will also allow us to mitigate our downside risk. If you're talking about it in terms of fiat standard, right, where you are trying to generate fiat dollars for your investors, then that's an excellent strategy. Long term, though, the idea of the Bitcoin Denominator Group is that Bitcoin will emerge as a neutral reserve currency for society. So we want to start getting positioned to be on a Bitcoin standard and start denominating our AUM in Bitcoin. And then we can offer like a Bitcoin yield, similar to MicroStrategy. We can look at our fund performance and say, okay, how much Bitcoin are we able to generate by our operations, by our trading operations? And that will be an important metric for us to develop over time. I do also think that there will be a handful of other digital assets and cryptocurrencies that significantly outperform Bitcoin. And so understanding those and doing my research around those and working with people who understand those technologies and those protocols is going to be it's going to be a really key part of our fund.
I mean, you make a really good point about passive versus active. Like, 'cause I think about this a lot too. And if you just like the Bitcoin CAGR depends where you start kind of calculating it from. If you bought Bitcoin 4 or 5 years ago when it was at 67K, you'd have a terrible risk-adjusted return. It'd be like 8% CAGR with like 70% annualized volatility. But there were also a lot of metrics like which you mentioned, right? That you were looking at that would have indicated it was way overheated at that point. You probably shouldn't, go on, probably DCA in before or after or whatever. Because if you had gotten in when it was 16K, right, then you'd have just an amazing return over the last couple of years, right? And so it goes to show you like the importance of timing and being a bit more active and having a sense of like where you are in the kind of sentiment or public froth scale, if you will, which someone who works on this full time like you can discern more easily. Because it's even hard for professionals, right? So now imagine a smart retail person trying to figure this out. Like it's really hard. So this is where maybe it does make sense to go with a fund as opposed to just buying Bitcoin, right? Because you probably buy it when everyone else is buying it, right?
So it's just being able to generate additional return on Bitcoin's CAGR, but also I think, like I said, the key component as well is to not lose your Bitcoin, right? And to know what you're investing in, right? It's interesting to me when I hear, someone say that they have exposure to Bitcoin, but come to find out they actually are invested in like XRP or something, and it's not Bitcoin. Or they say, yeah, I bought Bitcoin, and they bought the Bitcoin ETF, which is great, but they're not able to take advantage of the blockchain technology behind Bitcoin. They can't, send peer-to-peer Bitcoin, or they can't, do other things that having spot Bitcoin allows you to have. So I think there's a huge educational gap that we hope to fill there.
And like tell me like what kind of challenges have you seen or like what kind of hard lessons have you learned throughout this process? I know the fund isn't launched yet, but like
Mm.
can you tell me a little bit about that?
There's just a lot that goes into setting up a fund, especially when it comes to the back office administration stuff, the NAV calculations, the reporting, the compliance, the legal, the tax. It's really arduous and meticulous. It's like almost a never-ending checklist of things that I've had to do on a daily basis to get ready for this launch.
Mhm.
It's a great learning experience. I'm looking forward to having it actually launched. I mean, even the PPMs are going to be a couple dozen pages, right?
Mhm.
So those investor docs, just being able to comb through that and make sure they're ready. I think there are some unique aspects of our fund that we hope to utilize to differentiate ourselves from other funds, such as in-kind redemptions. If you have a Bitcoin ETF right now, you're not able to redeem it for Bitcoin. You have to redeem it for dollars. And we want to be able to offer in-kind redemptions to our investors. So let's say, they've been invested in our fund for 4 years and they're looking to redeem 25% or 10% or whatever, but 1 to 3% of that they want to redeem in BTC. That's something that we want to make available. There is some more complications around doing that from a tax and compliance standpoint, because you have to make sure that you calculate the cost basis from what that BTC was when they first invested in it versus when you're sending it in kind redemption, or if they're going to do an in-kind distribution, if they're going to contribute actual Bitcoin as the investment, there's some tax and compliance things around that. So just being privy and aware of all the regulations and those sort of things is, it's way different than the DeFi world and the DeFi space, right? Where there's not a lot of regulation.
Running a fund is complicated. Sounds complicated. It sounds like it's complicated going in, but then you don't realize how complicated it actually can be with all the details, especially the tax stuff, right? For my own fund, that's something that I've been thinking about, right? Like because I have some quant strategies that are great, especially when you combine them. They outperform BTC, or they have outperformed BTC by a good margin. But then you ask yourself, though, what about after tax? But then the problem is like that also really depends on the particular investor situation. It's not like you can just. Have you thought a little bit about that? Like how to deal with that issue?
Yeah, I have. It's, question is like, what non-taxable contribution can I receive? And really, it depends, right? That the answer that everyone loves is it depends, because what happens is through your trading activity, you're going to probably trigger some sort of UBTI. And so even in a non-taxable account, that investor will be required to pay taxes on that event.
UPTIs? Sorry.
Yeah, UBTI. I forget the acronym and what that stands for, but it's funny because I was just going through this exercise and I had that because so I manage some separately managed accounts, and some of them are retirement accounts, and so these people want to be investors in my fund. So I'm going to have to tell them, well, you have to be aware of UBTI. So UBTI is unrelated business taxable income. So,
All
I
right.
think there you just have to make sure that you have a disclaimer in your documents so that any investor who's bringing non-taxable income into your fund is aware that they
Oh,
may actually have to report it. So you're sort of putting the onus and the burden on the investor in a way. But one of the ways to mitigate that is to just simply not include more than like, I don't know exactly what the right amount is. And again, I'm not a legal attorney, so I shouldn't be giving advice. However, I believe that if you like have less than 10% or less than 15% or less than 20% of your AUM
yeah.
is contributions from non-taxable accounts, it's not that big of a
Right,
deal.
like retirement accounts, IRAs, 401ks, or like checkbook LLCs. Yeah, probably checkbook LLCs would be the only one that qualifies. I actually recently set one up. It's pretty cool. Also pretty dangerous, I guess, if you're not sophisticated, because you can just, you could literally almost buy anything, including something that might be a bad idea. But no, really cool to have that option, actually. Yeah, so
Yeah.
like a lot of intricacies, right? I wasn't even thinking about UBTI, like, or retirement type funds coming in via LPs, because just the regular the regular taxable stuff is already complicated enough. So, and going forward, like, looking at the next kind of 5 years, what do you see as kind of an underappreciated opportunity?
It's a good question. I still think Bitcoin is probably the most underappreciated opportunity, but for someone like you and probably even people who are going to listen to this podcast, they already know about Bitcoin and they already have some exposure there. So let me give you a better answer. I think the most underappreciated opportunity right now is in the privacy space, especially with AI. Our user data is just floating around out there, right? And there are a lot of vulnerabilities to that that I think can be solved with zero knowledge proofs. And so I'm really interested in zero knowledge proof technology. In fact, there's a company called the Electric Coin Company that has spearheaded development around this. And basically, a zero knowledge proof is a way to prove something is true without disclosing any information about you. I don't know if this is a good example. Maybe it's not a great example, but if you think about your driver's license, right, and you're going to the store and you get a six pack of beer, well, that clerk is going to ask you for your driver's license so you can prove that you're over 21 years old. But that driver's license has all sorts of metadata that is irrelevant for you to be able to legally buy alcohol.
Right.
It has your eye color, your first and last name, your height, your address.
Even your precise age is irrelevant, because the only thing
Correct.
you're proving is that you're above 21, not that you're 46 or it's 23 or.
There will be an event in the future that wakes people up to the fact that we need to be more serious around privacy. We've just grown up in this era where we're so used to accepting the terms and conditions so that we could use this free app to play Pokemon or whatever. I really do think that something big might happen in the future that helps people realize the value of their information. I don't know. It kind of goes back to our conversation we were having earlier with trading. So I think that's one of the big opportunities in the next 5 years. I also am very interested in the genomics space. That would include like stem cell research and therapeutics like that. I'm not a doctor or expert there, but I did recently get some stem cell therapy done on my shoulder,
Okay.
and I was having chronic pain. I was unable to sleep at night, and it lasted for a long time. Finally, I decided to try stem cell therapy out, and it's like 99% healed. So I think that's an interesting space to invest in the next 5 years. And then on top of that, I think the robotics and AI space is still going to be interesting. AI, maybe not so much, but at least the robotic space and autonomous driving technology, particularly.
Yeah, yeah.
I still think Tesla, it's funny because they quote unquote had a bad earnings report a couple weeks ago, and the stock just went up. I learned the hard lesson in not shorting Tesla, right? And I
Yeah.
actually am an investor in Tesla now. So
I hear you on the privacy stuff. It's kind of funny how that happened, where we sort of just accepted all this invasion of privacy. I guess it's because unless you're like really, really sophisticated, you don't really feel it directly. Like every now and then you see kind of like a spooky ad about something you just talked about, or maybe something you just searched for, and it's just way too specific. This is where like blockchain can really kind of help, like with ZK proofs, but also just the transparency. Once you have transparency about like what's being shared and what's being monetized, and then you combine it with empowerment where people can actually monetize it in a decentralized way, then they might choose not to give it for free to Google Maps. Maybe they'll go on some like decentralized kind of product where they get incentives to share it, you know. because someone's going to be spending on them anyway. So they're like, all right, I might as well get paid for it. I can see that happening. But I can also see happening some really big obstacles from governments there, because I don't know if you saw this recent news article, like the European Union is now straight out banning any sort of like privacy coin or privacy crypto privacy service. And I wonder how that's going to clash with with these movements. In Ethereum, for example, Vitalik, the co-founder, he said like part of Ethereum's roadmap should be privacy preserving by default. So does that mean it's going to become like banned in the European Union but available in the US? I don't know. It's the usual struggle, right, between governments who want to know and control and people who want their privacy respected.
100%. And I think there has been some good news recently, at least here in the United States. So like the Samurai wallet developers have come back to the US now. I haven't verified that. I just heard that through X. Someone posted that. So I didn't verify that, but I think that's true. And then like the Ethereum developers, what's his name? Roman Storm? I forget exactly his name. He developed a privacy protocol on top of Ethereum, and that's, I think here, at least in the US, they're not looking at him as a criminal anymore, trying to hide something, which is the problem. Like our Constitution, one of the important parts of our Constitution is unlegal searches and seizures, right? So you should have to give consent for someone to barge into your home, but that's just not the way people think anymore. They don't value privacy, and I don't know what it's going to take. I hope I'm wrong on that. I hope there's nothing like horrible, but we already have so much, cyber crime anyway, that you'd think people would wake up to the idea that pretty much anything that you put on the internet isn't going to be private. It definitely creates a use case for zero knowledge proofs. And then again, it's not that you're trying to hide something. It's just that you should be able to give consent, and you should actually be able to monetize your data, like you said. Have you heard of a Hive Mapper?
Yeah, that's the example I had in mind. Exactly.
Okay, yeah, they're doing a great job with that, right? They're doing something similar to Google Maps, but they're paying people in. What is the token that they're using? Is it Helium?
Although I think Helium might be this decentralized cellular network. I know there are like a couple of interrelated deep in projects.
It's an interesting concept, though, nonetheless. You opt in to share your user data and you get paid in a token. And if that token appreciates in value, then you're being rewarded for sharing your data.
And presumably with ZK Tech, like you can be cryptographically assured that only certain data is being shared and is done in kind of a semi-anonymized fashion, right? Like not sharing my name, but I'm sharing like my age range, like you said, like am I above 21 or 20, 30, 30, 40, whatever. So I think like it's just that it seems to me like once privacy preserving tech becomes convenient enough, then it'll be like people just prefer to do it that way. It's just that like they make it so inconvenient to preserve your privacy that people go spying on them, but they're just like, but I just want to talk to my friends. So, but I think with blockchain and ZK Tech, like we could get to a point where it becomes so convenient that people start just enabling it by default. It's going to be potentially massively disruptive.
That's what this space is all about, right? All the disruption.
Well, Jeff, it was great having you on. I really appreciate it. And I think today's chat was pretty interesting. Do you want to share like, where people can find you or where people can hear more about your investing style and stuff like that?
Yeah, absolutely. My website is almsofcrypto.money. You can read more about my thesis and you can get in touch with me there. I'm also on X at Jeffrey Tief, and I have a Substack that I try to keep updated at least once every 4 or 6 weeks, and that's tief.substack.com.
Okay, that's awesome. Actually, I didn't know you were on X, so I'll follow you. I'll follow you there.